Hi, this is Chiro, here to give you some pointers on filing your taxes in Canada if you traded options such as puts and calls and are wondering how to declare your capital gains or losses. This video was made in early 2021 for the 2020 tax season, but tips should apply to future years as well. Do bear in mind that I'm not a tax professional though, so if you have any doubts, you should get in contact with a tax professional or CPA. In this video, I'll go through the resources I found on how to declare taxes on options trading and where they came from in the Income Tax Act. At the end of the video will be a summary of how to approach certain option strategies and some pitfalls I've encountered. Having filed my own taxes for a few years now, I wasn't keen on hiring a professional or going to H&R Block to dole out probably hundreds of dollars just to learn how to declare taxes on options. I started my own search like many of you might have, with a Google search. The table on this page more or less summarizes what you need to know, but I wanted to know where the information came from, ideally from an official source like the CRA. If you're only interested in this table and some examples, feel free to skip ahead to the timestamp shown in the video. The first sources from the CRA that goes deeper into this is IT 479R. But first, a quick briefer on income versus capital gains. The general gist is that capital gains applies if your trading isn't your full-time job and you're not privy to information not available to the general public. If this is the case, your gains are taxed at a 50% inclusion rate, which means that if you're paying 20% income tax and you gained $100 from buying and selling a share or option, you would be paying half of your 20% income tax rate, which in this case would be 10% or $10 of the $100. As shown on the Tax Tips website, IT 479R outlines approaches for each of the possible outcomes when buying or selling puts and calls. If you bought a call option, we see that for capital gains, the rules in Section 49 of the Act, which we'll get to after this, apply, and that if the option is exercised, you add the cost of the options to the cost of the shares. Otherwise, you declare a capital loss or capital gain on the call option when you sell it. We're ignoring the section about people who are treating the gains and losses as income, but the rules are there if you want to read them, and they're generally a little more straightforward than with capital gains. It's a little trickier if you sold a call option, however, for example, as a covered call, as it is assumed to have been acquired at a cost of zero before being sold. This means that you will need to declare a capital gain in the year that the option was sold, whether or not you hold it until a later year. If the call option gets bought back, you declare a loss at the time that you're buying it back. If the option gets exercised, however, the capital gain no longer applies and you subtract the premium you received from the option from the cost basis of your shares. Because the capital gain no longer applies, this may require a refiling of previous year's taxes. I won't go over the IT 479R descriptions for puts, but we'll show them on the screen in case it saves you a trip to the video description to read the document itself. It's conceptually similar to call options though. You declare gains or losses if it gets bought and sold, or vice versa, and affects the cost basis of the shares if it's exercised. For completeness sake, I'm currently showing you the section of the Income Tax Act, Section 49, that discusses the adjusted cost basis of options that are sold, like for a covered call or as a cash secured put being nil. This helped me tie together why capital gains are declared the moment you sell an option, which is because they're considered to have been acquired for free, then sold for a premium. So back to our table. I think the most instructive examples to go through are ones where you buy or sell an option in one year, then close or exercise the option in the following year. If you open and close the option within the same year, then it'll be a simpler case to deal with. At this point, I'll remind you that my intent is to try and make these mechanisms easier to understand, not to provide tax advice, because I'm not a tax professional and it's very possible that I made a mistake somewhere. So do your research. If you sold a call in 2020, you'd declare a capital gain for 2020. If the call expired worthless, there wouldn't be any further action required. If you bought the call to close in a later year, you would then declare the cost of buying back as a capital loss in 2021, whether or not you actually gained or lost money on the overall position. If it's exercised in a later year, however, you'll have to go back and refile your 2020 taxes and instead subtract the premium from the average cost basis of the shares you sold. As something else to consider, if your options are exercised before you file your taxes for the previous year, you can adjust it then and there, avoiding having to refile. Selling a put in 2020 would be similar. You declare a capital gain for 2020. If it expired, no action is required. If you buy it back to close in a later year, you record those costs at a loss at that time, whether or not you made money overall. If it's exercised, you'll have to revise your 2020 taxes to remove the capital gain and subtract the premium from the average cost basis on the shares you bought, and keep track of it from there. Buying options is a little more straightforward, since it's more similar to just buying or selling shares. If your calls expire worthless, they're a capital loss in the year they expire. If you sell your call, you declare your capital gain or loss in the year you sell the call. If you exercise your option, you don't declare any gain or loss, but the cost of the call option will need to be added to the cost basis of the shares you acquired. If you bought a put that expired worthless, you declare a loss in the year they expire. If you sell the put, you declare your gain or loss on the put in the year you sell it. If it's exercised, you'll again need to add the amount you paid for the puts to the cost basis of the shares you're selling. In attempting to file my own taxes and considering the tax implications, the first handy tip I have is to keep excellent records. My bank's tax documents don't properly handle adjusted cost bases for capital gains. It seems to handle it as if it's income. So selling puts and intending to hold the shares indefinitely will require me to keep track of the required change to adjusted cost bases. Secondly, it's tricky to keep track of adjusted cost bases when options are involved. If you've started trading a stock and closed all positions on that particular stock by the end of the year, I've chosen to ignore tracking down and updating adjusted cost bases, since the sum of all gains and losses on that particular ticker will be the same. So that's my crash course in looking at tax treatment of options. Hopefully I've helped you get a glimpse of how it works. If you'd like to learn about some of the companies and trading strategies that have contributed to my overly complicated tax returns, check out some of my other videos. Let me know if you see any mistakes or have questions in the comments, and I'll see if I can look into it. In any case, have a great day.